Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is, April 3rd edition of Market Outlook. So, quite the week. Rallies relentless. We have a divorce from oil, energy, and the markets, which is interesting. Obviously, our text denotes some interesting observations, and we'll get into that, and some possible alternatives when looking at some long-term plays relative to the change of infrastructure for the global markets regarding energy. First of all, S&P 500. As you can see, not a lot of huge volume coming in. In fact, we have not had a really true accumulation day really since mid-February. So this rally and the volume pattern were relatively light. We'll get into some of the market internals in a moment. But let's just take a look at the market structure here. Clearly, the 200-day moving average, which sits right around the 201.60 level, and critical support, which really comes in around 201. Look at these spikes here. These were lows and openings right underneath the 200-day moving average, but we managed to close above it in each one of these days. I consider the lows on that day critical support. Also, this sort of spinning top or doji day here also coincides with 201. So that is really your line in the sand, because you'd be taking out the 200-day moving average as well as actual price support as well. Now, if you're more of a shorter term trader, you might want to consider looking at this yellow line here, which is our adaptive moving average. That gives you support around the 203 level, and actually the lows of last week are fairly important as well. But to me, the real critical level is that 201. Now, that's a good 2.5% from here. So that's just the way the market's set up. Now, on the other hand, let's take a look at the upside and see what that is telling us as well. Well, first of all, as you can see, we've been trading sort of in this massive channel going from about 180 all the way up to about 210. So that's a 30-point channel. That channel has been working its way really for several years now. I mean, that's going back really to the end of 2014 or so, where that channel really starts working its way through. So those highs here in late 2014, which continued, you couldn't really make much travel, but this is really your defined pattern. Anything from the highs above here would indicate momentum has really broken out to the upside. Now, what is interesting, you can see this critical level before the really big drop coincides now with exactly the top of the trend line. So we really want to see we're really within a close shot here to the upper end of the trend line. And again, a move over the next couple days above the 210 level would really put us above the channel line, and that would be a big positive. Obviously, the way this market works is maybe a breakout above it, and then we want to make sure that it really holds there as well. But those are your two important levels, that 201 for support, and if we break that, you could get a possible test, certainly down to the 50-day moving average or lower, or even a potential test of the bottom of the channel here as well. On the other hand, to the upside, we really want to see this thing now clear the upper end of this channel. So that's what we have on pure price. Now, let's go to the website and take a look. We're going to go to the resource section, and we're going to look at Little Big View. Click on Little Big View, and we have the whole market internal section, which I've been referring to. So interestingly enough, we've got, as you can see, we have in the Dow Industrials versus the S&P, we actually have 4 distribution days in the S&P because of those indecisive days earlier in the week. But overall, if you look at the overall market here, you basically have about as many accumulation as distribution days, with the exception of the S&P. So that's a bit of a yellow flag, but I'm not really all that concerned because the other indices are really looking absolutely more positive. You've got more accumulation than distribution days. So I would call this more of an overall, looking at all the key indices, more of a positive than a negative. But let's watch out here for continued what's happening here in the S&P 500, because we did get those 2 extra distribution days, and we've got now more on the S&P distribution days than accumulation days. So yellow flag, but green flag for the diamonds or the Dow and the NASDAQ. So overall, I consider that a slight positive looking at volume patterns. Okay, let's take a look at the sectors. And this is interesting because it is certainly a positive environment for the simple reason we are above the 200-day moving average. And we have many sectors that are demonstrating 6 months positive relative price movement, right? So because of this rally over the last month and a half or so, we've definitely moved semiconductors, technology, and interestingly enough, non-speculative, generally considered conservative plays, utilities and consumer staples are leading. So you have speculative sectors and really conservative sectors. This is not something you see very often. So net, the number of sectors positive, and with the index above the 200-day is an overall positive. But underscoring this is the fact that generally conservative sectors are the 2 outperformers of all sectors across the board. So I would give that, again, a positive, but a yellow caution flag, because what is normally those conservative plays moving into the market when markets are under pressure are outperforming. Now, considering that people are looking for consistent yield, that's not surprising either in an environment where interest rates are really low. Okay, let's take a look at some of the market internals. We're going to take a look at advanced declines and up-down volume. So up-down volume, again, sort of a neutral reading. The McClellan oscillator, which looks out over the next couple of weeks, actually held that midpoint, which was really important. So I give that positive here unless we start to fail and break under that dotted line. And advanced declines, again, working off an overbought scenario by going sideways to down and the market going up, and that is a more positive scenario. So over here, looking at advanced declines, more of a positive in the fact that the market has acted well in the face of being extremely overbought. That's not uncommon. When you get really, really rich, something I've pointed out, sometimes the market continues to move higher as it works off its overbought market internal readings. And that's what seems to be happening here. And again, I'm going to watch that McClellan oscillator and that dotted line. You can always come back to the website, see how this is doing on a daily basis. But right now, it's looking, the McClellan is certainly looking positive as it has not flipped down. Now, let's take a look at NASDAQ. NASDAQ, similar reading. We basically crossed down under that 0 or the 50% line in the advanced declines on a 10-day basis, and then pulled back up. Now, what is interesting, up-down volume definitely getting a lift here, so that's a positive. So again, with NASDAQ moving above its 200-day moving average, making a really strong move on the back of biotechs, really helped out the market. That's a definite upgrade based on phases there. You're now into an accumulation phase, and that's a significant improvement. And again, as you can see, the volume moved up pretty well. So again, more of a positive here on the up-down volume and the advanced declines in the composite index. Looking at new highs, new lows, as you can see, we've been running in very strong territory. We continued to improve during the week. That's a positive sign. Again, a real positive here, looking at new high, new low ratios on the S&P 500. Interestingly enough, big improvement, even a bigger improvement, was in the NASDAQ 100. So the new high, new low ratio really picking up, getting stronger. So again, market internals across the board look to be much more of a positive than a negative. And let's take a look at market sentiment. On the Bollinger Band, we are not at the lower end of the Bollinger Band. We are obviously drifting lower and lower in terms of volatility. People are definitely getting more comfortable as the market moves up, but not excessively so. Let's take a look at the volatility of options here, which is a good lead indicator. We were clearly overbought, worked sort of our way sideways, and again, now back to turning up. So I'm looking at this until we again turn down and get down beneath the 1.2 level here in the VIX of 1 month versus 3 month. This is a pretty good sentiment indicator. And again, although we overall are running a bit rich with the momentum of the moving averages turning up, that sort of mitigates it. So for the moment, I'm looking at this as more of a positive until we get a definitive turn down here as well. So again, it seems like market internals definitely digesting this huge up move and not looking quite as frothy as it did before this sideways action occurred. And then these two big gap days really resolving itself to the upside. So this is a case where some of the market internals overbought, but worked its way through sideways and then ultimately up action, which is extremely positive. Now, let's go back to some of the charts looking at energy. We said we'd look at it. So USO, just taking a look at USO, you can see, for one, we're trading beneath the 200-day moving average. We are in a recovery phase, but look what happened over the last couple of days. 1, 2, 3, 4, 5. And since the market, the equities market has made new highs, this has sold off quite a bit. We were running up at 1072. We're now down at $9.33. So that's a good 15% move to the downside. That's quite a bit as equities have moved up. So there's quite a big spread there. That is the divergence that we're talking about, holding that 50-day moving average. Now, in terms of alternative energy, right? I did a lot of research, and there are a couple things to note. A fan. This is alternative energy, wind power plays. And take a look at this chart. This is a weekly chart. I'm going to compare this. Again, this is sort of looking like a head and shoulders bottom here. Now, what's important is this long-term moving average, right? We've moved up quite a bit from the lows in 2012. Now, listen, all this stuff got hit really hard. Lower energy prices means the move to alternative energy not as critical, but I think that's going to shift. Overall, though, you can see we started all the way up at 30, but more important, take a look what's happening here. The weekly moving average, that's the 200-week moving average, is really holding. Now, if you compare that to USO, which is a pure play on crude oil, not even close, right? So alternative energy, wind power, is definitely gaining relative to the huge drop in the underlying oil market. Now, there's another play, another ETF, GEX, and a very similar thing is happening as well. This is also a play on utilities infrastructure with an alternative bent. And take a look at this. Although, yes, we did break down, we moved nicely over the longer term average that we like to use, which is this 200-week moving average. And it seems to be coiling just under the shorter term moving average here on the weekly charts. Now, again, quite a bit different than looking at USO. Of course, the other is TAN, which is solar energy by itself, and that is still under a lot of pressure. Now, one of the reasons is dominated by a lot of companies that are related to China. They're big in this, and Chinese stocks in general are under pressure. So what I do want to watch for, obviously, is a turn up in solar as well. But you got three interesting plays there. You've got TAN, you've got GEX, and you got FAN, which basically those two are definitely showing good relative strength in the light of this oil glut. Now, I want to reemphasize that they are very thin, not to be traded actively, to be put away. And again, those seem to be in a better technical setup than the oil market or the solar power as well. So just let me go back to that again. FAN. And again, this is very, very thin, but look at this on a daily basis, right? We actually acted very well on Friday relative to the oil market, which got hit and was down almost 4%. So again, interesting that this has bottomed out and now starting to move higher. And again, it looks like, right, that $10 level for if you're a longer term player is absolute critical support. Now, I can't emphasize enough the fact that we have extremely low volume. All right, so again, perspective here, you can see some of these alternative energy plays potentially setting up. Look at this FAN on a monthly basis. If we can start moving above this adaptive moving average and through the new highs that were put in the last several months, we could have a nice breakout from 12 to easily 14 or 15 or so, where important resistance comes in around here and here. But overall, I'm really liking this potential head and shoulders type pattern. All right, hope this helps. There's a bit of a longer term perspective. See you next week. Stay frosty because these markets are certainly interesting.